All right, welcome back to another video on the channel. I'm Jason. If you're on this channel, we have over 500 videos and you have probably seen my face before. I'm going to start doing some longer form content because I want places for people to go to basically answer the questions I spend hours of my day on the phone for. That doesn't mean I don't want to talk to you. I just want to talk to you about, specifics, and general information is just easier digested via audio in your free time, even on paper. So I'm going to start putting a lot of the information I get asked about in long form video content. You can pick it apart as you need to, and then if you have specifics, you still call me. But this is just to help you guys out. This video is going to be just an overview of DSCR loans generally, specific bullet points and things like that. I'm not going to go into what a DSCR loan is. If you're watching this video, it's likely you already know what that is. But if you don't, give me a call or go to the other video in this channel that talks about what a DSCR loan is, because there's probably 10 of them. This is meant to be conversational. I'm going to kind of riff. You can put it on 2x if you don't enjoy that, if you want to just get to what you need, but that's okay. And I'm just going to do a lot more videos like these to serve the broader audience with knowledge. Also, for your benefit, these notes are going to be down in the comments for you to download if you don't even want to listen to my mug talk about these things. So yeah, this is going to be very loosey-goosey, but let's just get into it. So credit requirements, I'm just going to go through the basics, what you need, how it can be better, things like that. So basic credit requirements, most lenders, including us, are going to require you to have around a 660 credit score. There are lenders out there that'll go less, but you're going to be impacted on the rate and the cost. And my suggestion, if you have less than a 660, is just to get a credit partner to come on the deal with you, a spouse, a family member, trusted individual, something like that. But 660 credit score is going to get you kind of prime terms for DSCR loans. The DSCR requirement, meaning if you're going to cash flow or not, should be at least 1. Now, that begs the question, can we go less than 1? And the answer is yes, but the rate is impacted, usually 1.5 to 2% higher. So again, we want to put you in good loans. We want to give you good terms. We don't want you to look at our term sheet and cringe about it. So we just tell you up front, like, you should have a DSCR of greater than 1, and we'll go over an example of that in a minute. But if you have a property that, say, the value is super high, you're not getting the rent you need, but you still want the higher LTV, if you're an equity investor or something like that, like there are investors that do this and it's totally fine. We can have a DSCR of less than 1 and still get you the 75% LTV. Just realize your interest rate on that loan is going to be higher. Rate is usually correlated with risk. If a property doesn't cash flow, the rate's going to be higher because the risk is higher. I hope that makes sense. I started typing this and then realized it wasn't recording. How do you look at DSCR? So we get this all the time. We created a free app. It's free, rentalpropertycalculator.com. I'll put that link down below too. But basically, you put in your hypothetical number, you put in your real numbers. I'm going to put in hypothetical numbers. So let's say we're making $3,500 a month, taxes, whatever, $4,000. This is just an example. You can punch in your own stuff. 275. Okay, so this calculator will give you the real time what your DSCR is. So when you come to us, you know already what's going on. And then when we give you the interest rate or the loan amount, you just change the interest rate and loan amount numbers, and you'll get what your actual DSCR is. So we prefer a greater than 1. We prefer the property to be making a surplus of income each month. That doesn't mean the property is profitable. We don't take into account maintenance costs, replacing water. We don't take into account anything like that. But from a practical property taxes, property insurance, if there's an HOA, we look at the rental income, and then we look at the mortgage payment, and we go, is this going to be a surplus each month? That's what we look at to determine that. If you're greater than 1, you get ideal terms. So just keep that in mind. Again, you can go to freerentalpropertycalculator.com to do this. Play with it all day if you want. I guess if you're going to use these, I should make this a little more readable, huh? Something I didn't talk about on credit score. Can we go less? Yes. But your LTV, meaning your loan amount, impacted, meaning the leverage will be lower and the rate will be higher. We can go as low, believe it or not, we can go as low as a 500 FICO. We don't like to because the pricing is not great when the alternative is to get a trusted individual. Usually people have these, a spouse, a sibling, whatever, um, to come on the loan with you. And then you clean up your credit over the next 3 to 5 years and then take them off the deal and then it's yours. Um, that's what we recommend to people each time instead of doing this, these reduced leverage loans, because oftentimes they just don't work, especially if you did a hard money loan to start out with to get the property up to snuff. All right, what else? Tenants. So we can do basically anything. So we can do um, vacant. We can do tenanted, however you spell that. We can also do, we've seen a lot of these rooming house deals lately where people are using residential to, do sober living or stuff like that. Um, that's okay. What else? Yeah, I don't know. There's more examples like that, but basically anything with a tenant we can do. What else? Seasoning. That's the big question for flippers out there, are people who rehab properties and then refinance them. So people in the Burr method. None required. That's right. You do not. You could finish your rehab, refinance at ARV. You can finish in a week and refinance the property at ARV. The stipulation is that you have to do a value add, right? So have to do rehab value add. So you cannot buy a property at a deep discount, paint the wall, and then use us to refinance with no seasoning at the ARV. You're gonna have to wait the 6 months to do that. But if you actually do a value add, where you want to do the Burr method and cash out, you do not need to wait. We do a lot of these. People rehab a property and a month later they refinance out, pull their cash out, and go do it again. This allows you as an investor to move very, very, very quickly. So no seasoning on that. Now the heavy hitter questions, leverages. Everyone wants to know this. So in a lot of markets, we can go up to 80% cash out, no seasoning, and we can go up to 85% rate and term. That is probably some of the highest leverage I've seen. But if you're not going to pull cash out, let's say you're not pulling cash out because your hard money loan was highly leveraged and the market dropped. If you're going with most lenders, they're at 75% LTV. They're going to make you bring that extra 10% to the table to pay off that first loan. We will go up to 85% rate and term refinance, which means you're not pulling cash out. I think the definition by that is 2 or 3K. Net funds is less than 2 or 3,000, but yeah, so that's pretty competitive too. So those leverages are pretty competitive. With these higher leverages, you do have to have a DSCR of greater than 1. All right, so just keep that in mind. Asset classes. So for most of the people watching this video and kind of the intended target audience is 1 to 4 unit residential is what we're really going to talk about in this video. We can do more. There will be another video on bigger assets and commercial and all that stuff. But for this video, the scope is 1 to 4 unit residential. Anything above 4 units is considered commercial in the loan space. And so those numbers and requirements are going to be different. I don't know. I'm going through my list here. I'm kind of, again, we're off the cuff, but why DSCR? The big why for this, is simply because no income verification, no taxes, credit issues are okay. I mean, you can have a late payment, stuff like that. We're still going to do the loan. What else? For cash outs, you can use the loan proceeds versus having the money in your bank. And I know we're actually talking about a lot about refinance here, but I'll add this back up top again off the cuff. For DSCR, if you're an experienced investor, which means you've got at least 3, you own at least 3 rental properties or 3 investment properties, we'll go up to 85% of purchase. You need a 740 FICO for that, and that's SFR only. Otherwise, 80% purchase. So yeah, we talked a lot about, a lot of this stuff is still the same here, but I just mentioned refinances. So again, off the cuff, follow me. Okay, you can use loan proceeds. What about for purchases? No seasoning on funds for purchases. That's pretty good. A bank was going to require you to season it in a lot of cases. What else? Hmm. Yeah, I mean, that's kind of the big stuff. And then last but not least, because non-owner occupied properties, I need to emphasize that these types of loans are for non-owner occupied properties. You cannot be living in these properties because the whole premise of this type of loan is rental income. So you can't even house hack. You got to go do FHA, VA, whatever to house hack. You cannot house hack with these loans. It must be non-owner occupied investment properties. Um, yeah, so I'll just close up with that. Any questions, you can go to privatemoneyquote.com. You can also look in the comments and you can submit scenarios on privatemoneyquote.com. But we love to talk to people, but we also want to provide you some value so you can passively take this in and just get an idea instead of calling 50 lenders and figuring out this. The requirements I said here are cover probably 85 to 90% of nationwide lenders. The big difference you're going to find is the leverage and the underwriting as far as like looseness goes, right? As far as like what they look at. So I've saved you a lot of time, I believe. But if you still have questions, privatemoneyquote.com, you can submit a scenario there. You'll also find contact info to give me a call directly. We would love to help you, and we hope this type of video format is better. It's more conversational, I hope. It's not super edited. And last but not least, if you want to remember, freerentalpropertycalculator.com. You can go play around and calculate your DSCR. So when your lender tells you you need a greater than one, you know where that number comes from, so that when you get the appraisal back and you're ready to go, you don't, you're not surprised by anything. I hope this helps. There will be more videos like this, and I welcome your feedback. See ya.